Hello, welcome to another virtual event hosted by the Bipartisan Policy Center. My name is Dane Stangler with BPC. We were originally supposed to be joined today by Congresswoman Young Kim. Unfortunately, Representative Kim is unable to join us. We will have her back very soon for another BPC event, but I have a terrific panel joining me today. We're here to talk about the last few months of turmoil in the bank markets, regulatory scrutiny in Congress, and what all that means for American businesses. What it all means for those non-financial businesses that rely on banks, that rely on non-bank sources of credit to grow and to hire. Before I introduce our panel, I want to remind the audience that you can submit a question using the hashtag BPC Live on YouTube, or send it over Twitter with @BPC_bipartisan. Now we'll get to our panel. A very distinguished lineup to talk about these topics today. We're joined by Jamal Hagler, Vice President of Research at the American Investment Council. Jamal, thanks for joining us.
For having me.
We have Kevin Brady, he's a co-founder at Newbury Franklin, and we'll talk about what Kevin's business does. But Kevin, thanks for joining us.
Happy day.
And last but not least, we have Steph Miller. Steph is a senior research fellow at the Mercatus Center. Steph, thanks for being here.
Yeah, thanks for having me on the panel.
So we have this big topic: banking, market turmoil, regulation, business. There's a lot going on here, and it's in the news practically on a daily basis, or has been over the last few months. There's a lot of topics to cover with our panelists today. Steph, I want to start with you, because you spend a lot of time researching these issues. You spend a lot of time thinking about these issues. We've heard a lot in the news every day about, oh, this bank failure, that bank failure. Here's how it stacks up. Here's what it could mean for American businesses. To start out, can you set some context here for us? Like, situate all these bank failures, situate all this attention, this current moment, kind of in a historical context based on your research.
Sure, thank you. I think you have to go back to COVID and then the rise of inflation, and that killed the bond market and the equity market. So not only did that hurt households who were trying to save for retirement, but it also hurt banks, because banks do hold a lot of securities, especially the larger ones. So as the bonds were dropping in value, that also hurt the value of the portfolios that the banks have. And because of that, that spills over to the loan portfolios that they have, because now they have to be more wary of the credit that they extend. They have to be more careful. If you look at the senior loan officers' opinion survey that the Fed conducts, apparently a lot of loan officers are reporting tighter credit standards, lending standards. They're reporting higher borrowing costs for those borrowing from the bank. And then also there's a lower demand for credit. So there's definitely a problem here going, I mean, right now with small business lending, but it's not just small businesses, it's also larger businesses as well. And I think if you want to look at, a lot of the headlines have made points about SVB being the second largest bank to fail in U.S. history. And then right after that, then First Republic was now the second largest, because it was even bigger. But you have to take those numbers and think about them a little more, because they're not adjusted for inflation. So Washington Mutual was the previous, or still is, the largest bank to fail. And if you translate its failure into today's dollars, that amounts to about $424 billion in total assets. So it's roughly twice the size of the two banks that failed. But even that's not really a good measure of how bad this is in terms of a banking crisis. So if you just sum up all the assets of the banks that failed, and then compare that with the $23 trillion in total assets that are in the banking sector right now, that winds up being about 2.7%. Now, if you go back to 2008, at the peak of the crisis, if you summed up and in that case, there were about 500 banks that failed. So if you sum up all the assets among those banks, including Washington Mutual, that wound up almost being 18% of total banking assets, which was only 11 trillion at that time. So there's been a lot of growth in the banking sector since then. And I would say we're not out of the woods yet. I wouldn't call this a crisis. I would say it's 3 failed banks, but I think there could actually be some more down the road.
Thanks, Steph. I definitely want to come back to the regulatory point with you. Tossing around these numbers, it's funny to hear you say it was only 11 trillion at the time back in 2008. These are massive numbers that we're dealing with. Jamal, it's a good segue over to you. Steph gave us some good perspective with the banks. Obviously, those have grabbed a lot of headlines. You mentioned Silicon Valley Bank and the failures of First Republic. Tell us about the American Investment Council, your members and what they do. And then I want to ask you about private credit, about these non-bank sources. So tell us about AIC and your members and what they do.
Thanks, Dane. So the American Investment Council is the leading advocacy and education organization for the private credit and private equity industries. And in our role, we seek to educate policymakers on what private credit is and how it's important to businesses of all sizes. Private credit is a broad term that encompasses several different strategies, but generally private credit refers to non-banks that invest in debt instruments or provide loans to small and medium-sized enterprises. This debt is not traded or issued on public markets, and investors tend to hold the debt to maturity. In the aftermath of Dodd-Frank, banks reduced lending to small and medium-sized businesses due to regulatory changes, and private credit expands the available credit to those businesses. As we deal with the aftermath of some of the turmoil in the regional banks, it's important to have additional sources of financing, particularly sources that are countercyclical. And most importantly, private credit funds don't have the asset liability mismatch that is present in most banks. And so they are not susceptible to runs. So.
Thanks, Jamal. You mentioned several things in there I want to come back to, especially kind of the very integrated role that private credit plays, both in a very high-profile way sometimes, we can read about it, but also behind the scenes and helping make markets work better and serving as a complement to bank lending. I also want to pick up, you talked about, post Dodd-Frank and some of the lending markets. I think CFPB, the Consumer Financial Protection Bureau, did an estimate a couple of years ago, and they estimated the total value of the small business lending market, like outstanding loans, at around $1.2 trillion. Not quite Steph's $11 trillion, but still pretty sizable. And only half of that, I think maybe not even half, was from banks. And I think almost entirely all the growth, exactly to your point, post Dodd-Frank, post Great Recession, had come from the non-bank financial sector. And I know private credit has been a huge source of that. I definitely want to come back to a couple of your points. I want to give Kevin a chance to talk too. Kevin, first, tell us about your firm. Tell us what you guys do.
Thank you, Dan. Yep. So Newberry Franklin's a holding company focused on acquiring and building micro-cap recurring revenue businesses. We end up acquiring and helping build businesses with anywhere between 3 million and 30 million of revenue, kind of when we come on the scene. This generally translates to buying businesses that start with, that are starting with less than 5 million of annual profit. Typically, what's unique about our approach, I think, are 3 things. Number one, we really view ourselves as operators rather than financiers. So my business partner and I operated a small and medium-sized business for a number of years together, and we try and bring that experience to the entrepreneurs who we support to help them grow their businesses over time. Second, we're long-term oriented. So we think about building businesses sustainably over a decade or even multiple decades is our goal. And last, we have a lot of experience buying small and medium-sized businesses from business owners. And, that requires rolling up your sleeves and kind of getting dirty with numbers at times on the one hand. Then on the other hand, it requires bringing forth a lot of emotional intelligence and compassion and empathy to the work that we do. Because oftentimes for these small and medium-sized business owners, selling their company is a major life event and or life transition for them oftentimes. So it's work that we take seriously, and it's a lot of fun as well.
Kevin, you don't have to name any names, but can you give us an example of some types of businesses that you guys work with and operate?
Yeah, so today, our family of companies comprise, three end markets, primarily. So we're in the home maintenance space or home services space. We also are in the industrial distribution space. And then last, we're in the vertical market software space as well. So we have three distinct, investment theses and platform companies in each of those distinct end markets right now.
Kevin, I want to ask you about your perspective on some of the market turmoil we've seen. I want to pause first on, I think it's really important to keep in mind that you talked about yourself as an operator, your firm as an operator. So it's we heard Steph talk about just the sheer size of the banking market. We heard Jamal talk about the role of these non-bank financial sources in private credit. I think it's really important as we, connect the thread here to remember that, you talk about home maintenance businesses. That's something that can resonate with everyone. I mean, almost every person in America has dealt with a home maintenance company in one shape or another. So I think it's really important to understand the things that Steph and Jamal have highlighted for us. They have real consequences, good and bad. We're talking about bank failures and credit contraction. They have real consequences for real companies that Americans deal with in their daily lives. So give us your perspective. What are you seeing? You hear Steph and Jamal talk about their perspectives. You're reading the papers every day. What's going out there with the businesses you work with?
Yeah, of course. And thanks, Dane. And across our small family of businesses, we're seeing three things. At the moment, number one, we're seeing rising costs, particularly in terms of frontline labor, as well as direct materials. And that's something that's been ongoing, for a number of years, during and even, since kind of COVID, showed up on our scene collectively. In addition to that, we're also seeing softening revenue demand across our businesses. This really started for us kind of late Q3 into Q4 of last year, and that's continued. And then the last thing we're seeing thematically lines up exactly with what Steph touched on, and as well as Jamal. So we access debt through regional banks, and we access private credit as well. Across our portfolio, we use a fair bit of debt to finance investments and or acquisitions. And we're seeing a lot tighter credit standards, particularly from regional banks at the moment. We're seeing higher rates of capital, and in fact, we're actually seeing some of the private credit folks help us weather the storm. And in fact, the spread between the traditional bank market and the private credit market is much lower there's less of a spread than I've seen in my career, which is unique when I'm talking to a more flexible, higher risk piece of debt that we're not as concerned about taking on the higher rate because the spread isn't as large as it typically or traditionally is. So that's kind of what we're seeing at the moment. What we're doing in response to that, perhaps, Dane, is we're not just kind of sitting on our laurels in this really challenging environment. When we saw the revenue generation in our businesses start to wane, we kind of hope for the best but plan for the worst. So what we ended up doing in our budgeting processes this year is, what's our contingency plan if revenue's not coming in where we want or expect it to be? And right now we're starting to act on those contingency plans. So, that might come in the form of trying to right size our cost base with less, revenue coming in the door reliably. Beyond that, we're just trying to really focus on what matters most, putting the customer at the forefront. So what's going to drive the highest ROI for our customers. And then where we can, we're going to try and really selectively think about acquisitions and or bringing on talent. But again, it's just a really challenging environment to go on the offensive. But if you have a strong balance sheet, you're fortunate enough to have a strong balance sheet right now, being selectively, going on the offensive selectively rather than entirely batten down the hatches is something that we're thinking a lot about as well.
Thanks, Kevin. That's super interesting. Before we transition into a conversation about the regulatory side of this, Jamal, I wanted to give you a chance. You heard Kevin talk about the his on-ground experience. You sit from where you sit, you talk and hear from a lot of members across the space. I just wanted to give you a chance to comment on anything you just heard from Kevin.
Well, I think, what Kevin said is kind of reflecting what I've heard from our members and reading through the documents in the marketplace, is that the spread between bank loan and private credit is starting to tighten, and that more and more firms are seeking to raise credit firms to expand on some of these opportunities and some of the dislocation in our credit markets. And so that's kind of what I've been hearing from our members as well.
Yeah, I think you both raised important points, which is, Kevin, exactly as you highlighted, there's some softening, some waning of revenue, but you both highlighted that there are businesses, still looking to grow or to invest, that still see opportunity, and these various financial sources can play a key role in helping them do that. Steph, I want to come back to you on regulation. We've heard it come up a couple of times. Jamal mentioned Dodd-Frank, years and years ago. Since the SVB and First Republic failures of the last couple of months, we've seen this get a lot of attention in Washington. There's been tons of hearings on Capitol Hill looking at financial regulation, banks, non-banks, whatever. Can you help us think through, we've seen lots of blame being thrown around, which always happens in these moments. I won't say the word crisis because you said not to use that, but in these moments. What role did regulation play? What's your perspective, and where do you think policymakers might be headed with this latest round of scrutiny?
So I would say, first off, for SVB, it was a badly managed bank, and the supervision doesn't seem to have been up to par with identifying risks. So the supervisors are supposed to catch the things that didn't go well within the bank. And so it's first and foremost, the blame lies at the bank, but then the backstop is the supervisors, examiners, and something's wrong in that process. So that said, there have been certain, Michael Barr, the Fed report identifies regulation. Some members of Congress have identified S-2155, which was the so-called Trump rollbacks of the Dodd-Frank Act, which was enacted in 2018. When it was enacted, I wrote a blog post at the time because there were people then saying, if you roll back Dodd-Frank, you're going to get a crisis. And I wrote a piece explaining why I didn't think you would get a repeat of the crisis in 08. Now, this is a little different because it's a different, the banks that fail for very different reasons than what happened in 08. So I think the people that are bringing up regulation are thinking specifically about Section 401 of the Act, which is so-called enhanced supervision. So that was supposed to say that for banks that were not the Big 10, but big but smaller than the Big 10, they were supposed to have more scrutiny from the regulators. And it's true that they lobbied against it. But the measure that we're talking about is the so-called liquidity coverage ratio. So what that basically was intended to do was guarantee that a bank would have enough liquid assets. So if people withdrew over a 30-day period, the bank could cover those withdrawals of funds. But remember, SVB failed in 2 days, not 30 days. And on top of that, some of the very assets that were supposed to meet the liquidity coverage ratio, specifically treasuries, they've experienced losses too. So most of SVB's book was in mortgage-backed securities, I think about 80%, and then the other 20% was, I think, in treasuries. If you had switched it or even gone 100% treasuries, I still think SVB, without the interest rate hedges, which was to protect against rates rising, they should have done that, but they didn't do that. And ultimately, all of that wound up resulting in the bank realizing losses. So in that sense, I don't think SVB is a regulatory failure story. And also the other three banks, well, the two banks that failed, as well as Silvergate, which voluntarily liquidated, I don't think they would have fit that story either, that it was a regulatory failure.
And I think, Steph, exactly as you suggest, now I'm going to go way beyond my sphere of expertise. I think some of those banks that fail had pretty high like tier one equity ratios as well. Is that correct? Or other measures of solvency and
Well, that
strength?
could be a panel in and of itself, or another session. But what I would say is I've studied bank capital for a long time, and there are the regulatory measures, which I don't think are very effective. And then there are the market and accounting measures, which are probably more effective, and especially the market measures. So in 2008, all the banks that experienced distress, they still were able to satisfy their regulatory capital ratios, their tier one ratio. The same thing happened here. All four of the banks that closed, the three failures included, they all satisfied their risk-based capital ratios. These are very complex. They require a lot of staff to compute. And even though the banks are able to make it look like they're well capitalized, all you had to do last year was look at the market equity or market to book, and you would have seen that was declining from end of 2021 all the way through 2022. So that should have given not only the banks, the equity investors were obviously on top of this, but the banks should have been saying, hey, we better do something. And even if they didn't, the examiners should have said something, and nothing happened. So
Thanks, Steph. Jamal, Steph just gave us a view from looking at this from the bank perspective, talking about regulation and scrutiny from Capitol Hill. Help us, like, what's the non-bank side? Where's the regulation fit in, and how is your industry thinking about this? Like, help give us a sense of the regulatory perspective from your side of things.
So from our side, private credit funds are well regulated. The funds are managed by investment advisors who must register with the SEC and comply with the requirements of the Advisors Act of 1940. These advisors are required to report extensive information to the SEC. Additionally, the Federal Reserve noted in their recent financial stability report that private credit presents a limited risk to U.S. financial stability. And like I mentioned before, private credit doesn't have the asset liability mismatch that banks do. Private credit firms use modest leverage, if any, and the level of interconnectedness by private credit funds is limited. And so, a failure of one fund does not necessarily crash other private credit funds, and the failure of a firm does not necessarily impact other private credit firms. So, from our view, the regulation is appropriate.
Thanks, Jamal. Kevin, I think, I don't want to put words in your mouth, but I think you probably have multiple perspectives on this issue of regulation, because you yourself at the firm have to deal with regulation, but then the companies that you are working with also have many dimensions of regulation. It can depending on their industry. So I'm curious, with the businesses you're working with, what has this conversation about regulation and the stuff you've heard Steph and Jamal talk about, has it like filtered out of Washington out to among the businesses? Like, what's the conversation out there?
Yeah, no, I certainly think it does filter out, Dane, and I think it filters out a little bit, more indirectly, perhaps. So when so the impact of regulations certainly show up indirectly when we're seeking to access capital, like first and foremost. So as I mentioned, we work with a regional bank. It becomes very clear in conversations with regional banks, like what they can and really what they can't do, right? And a lot of that regulatory work, I understand it came out of the last kind of great recession of 2007 to 2009. And if we have financing needs on a senior basis within a certain strike zone, we know the regional bank is generally going to be there for us up to a certain point. And it's very cookie cutter and clear cut. Like, they can't go outside of the strike zone. Like, so don't even ask, right? Because we can't get there for you. Conversely, like, private credit serves a really helpful place in our small and medium sized business market, because although it's not a tremendous amount more leverage, like on from a leverage ratio perspective, it does give you another half turn or full turn of leverage to help finance a project or help finance an acquisition. And the other nice thing about, about the private credit paper generally, and I might be generalizing a little bit, is that these private credit providers have much more flexible terms as well. So might be a more expensive cost of capital, but there's a lot more flexibility, and it helps kind of bridge a gap between where the senior bank market is and folks having to pony up very precious equity dollars, which is the riskiest place in the capital structure. So we certainly see that conversation, and what's changed now is that if we knew what the strike zone at the regional banks were, it's shrank. So like anything that came over the plate, to use a baseball analogy, if you threw a deal in and said, all right, I think this looks like a strike, it's not the investment committee or the in this scenario is not calling that strike across the plate. It's really got to be right in the middle of the plate in order to get a deal done in this environment. The other thing that I find interesting, just as I heard Steph talking, is that I find it like a little bit perplexing and kind of has me looking in the mirror a bit more around the fact that some of our banks didn't manage risk appropriately from an interest rate hedging standpoint. And I can assure you that a lot of small and medium-sized business owners are not thinking at all about managing interest rate risk, right? And in fact, like I'm grateful for some of the regional bank relationships or private credit, provider relationships that we have, because many of those banks actually were kind of in our ear saying, hey, you got to think about this, because how can you hedge your risk as rates are going to come rise dramatically in a short period of time. So I was really grateful that I came across others in the banking ecosystem that help us think through that risk as like the period of easy money has certainly come to a close now.
Boy, that's a really good point, Kevin, and really compliments. We heard Jamal talk about just the market role, the financing role that private credit can play. Steph's talked about the banks, but you're really highlighting kind of that informal perspective as well with these sources of finance and the role they can play with businesses. That's a really good point. As a diehard baseball fan, I'm also interested to see if you can extend your baseball analogy through your answers to the rest of the program. Steph, Jamal, before we turn to another question, I just wanted to give you each a chance to respond to each other in this discussion of regulation. Any other comments on this?
I can just quickly add one thing, which is that I just recently read a study that pointed to regulation as being a reason for the move toward big firms in the U.S., not just banks, but even real sector firms in the real sector. And it seems that I think the cutoff was if you're under 100 employees, you're being squeezed, wages going down, revenues going down. And if you're over 1,000, it's the opposite. Revenues going up, wages going up, things like that. So I think it's not just bank regulation, it's federal regulation. There's also probably local and state regulation that are all affecting the business landscape and making it hard for especially small businesses. So
yeah, that's another good point too, Steph. I think if you look at a lot of small business surveys, whether from Census or private sources like NFIB and Goldman and the Federal Reserve, I think you see exactly that. You see that they've been really struggling with rising costs, including wages, but rising costs across the board. Interestingly, I think in the latest census survey, the BTOS, I forget what it stands for, but their survey of about a million, sample frame of 1 million small businesses, most small businesses in that survey said they hope to stop raising their prices in response to their own cost pressure. So they're struggling with it, they're feeling with it, but they do have that glimmer of hope on the horizon that we're going to get past this. And exactly as you both have alluded to, I want to remind our audience you can submit questions with the hashtag BPC Live or tweet at us at BPC_bipartisan. Jamal, we have a submitted question for you on private credit. You and Kevin have both mentioned this, but it's a question about the cost and its relative cost in terms of small business financing, more or less expensive for small and medium-sized businesses.
I think it depends on the situation. And as Kevin mentioned earlier, we're seeing credit spreads tighten a little bit between private credit and traditional bank loans. But I think, one thing we have to ask is the loan going to help your business grow and expand margins? Private credit can provide financing at the speed that other providers of credit are unable to match, right? Particularly banks. Private credit can offer customized bespoke loans that fit the needs and the repayment plans of the businesses that they're investing in. And because private credit investors hold some of these loans to maturity, they're able to kind of have more bespoke options that other folks would not necessarily, other banks or other types of lenders would not necessarily accept. And then I think, working with private credit firm can ensure its certainty in financing, which is important. And, I think lastly, of course, at some times you'll be unable to get the loan anywhere else. So, is it more expensive if if the question is getting no loan or a loan? I think, you have to think about it in that way as well.
That's a great response, Jamal. It also underscores something that Kevin said that I wanted to highlight, was not just differences in types of credit, but also the difference in terms of between debt and equity, and that decision that small businesses face. And Kevin talked about some of those trade-offs. Jamal, just a follow-up question to what you just talked about. And again, you've touched on some of these points. There was just an article in Bloomberg earlier this week about BlackRock coming out and very publicly saying they now have a much stronger preference for private credit versus public sources of finance in terms of not just higher yields, but also the role it plays in the economy. I think that really strengthens, what you've been saying in terms of the role of private credit and its attractiveness, not just for businesses, but also for investors as well.
Absolutely. I mean, I think, asset managers as well as those that invest in asset managers or credit funds see an opportunity here, particularly as banks have stepped back. There's, thousands of businesses that need this capital and they are safe to lend to, I think, but because of certain regulations and requirements, it's a little bit more difficult for banks to get there. But these credit funds are able to take a little bit more risk than some of the banks and provide financing to these growing businesses that support jobs throughout the country and help drive some of the innovation that America is known for.
Steph, we have another submitted question specifically on technology in financial services and in banks. There's been a lot made of, for example, the role of social media in the run on SVB. Obviously, we've seen financial technology penetrate deeply in the whole financial services industry over the last 10, 15 years. Can you talk about just, from your perspective, your research, the role that technology that you see it playing, the role, how that role is evolving, and implications for borrowers and businesses?
Sure. I think before I get there, I just want to say that I'm not of the view that this was a social media sparked run. I think that maybe hastened it, but it was not the cause. And if you had just looked at their stock price, their market value of equity last year, you would have been well aware that something's up at not just SVB, but the other banks. Now, that said, in general, a bank that makes use of technology is probably going to be doing that to become more effective, efficient in their operations. And to the extent that they can, they will do that. But there's also, and if you just go back through history, for instance, I think the first cable communications were for the purpose of transmitting news across the Atlantic between banks. So there was, I would say, a period when maybe banks were at the forefront, but now that's no longer the case. And I think regulation is probably a reason for that. Now, that said, when it comes to banks originating loans, there was a view when banks started getting larger that because they don't have that personal relationship with their customers, that they would be at a disadvantage, and that would cause lending to especially small businesses to dry up. But that didn't turn out to be the case because of credit scoring technology. And I think they've been very good at making use of credit scoring technology. Now, after Dodd-Frank in the mortgage space, you saw a rise of so-called fintech mortgage lending. And one study I have seen looks at, they asked the question, was it the innovation and superior performance of the fintechs, or was it regulation? And it turns out that about 60% of the growth in mortgage origination for fintech firms was due to the regulation that the banks were facing. And I think that's what Jamie Dimon meant when he said we're partnering with fintech firms, right? Back, this was probably 3 or 4 years ago. No, maybe 5 years ago. And but the other 30% was technology. So to the extent that so there are some technological advances that are helping fintech relative to banks, but to the extent that banks can make use of new technologies, they will have to compete with the other finance providers in that space too.
Thanks, Steph. Jamal, Kevin, any comments on this question of the role of technology? It's a very broad question, but any comments on this issue?
Well, one, I think, technology has helped some private credit firms to assess the creditworthiness of the businesses that they're looking to lend to. One, I think that's something that is helpful and important. And then two, I think, one thing where when you think about the regional bank turmoil is that I think we need to adapt to the speed with which information can be disseminated and the speed with which you can move your money, online banking and being able to instantly transfer your money out of a bank, I think helped to bring on some of this turmoil as well.
Kevin, any comments before we move on?
Yeah, I mean, just from from the operational perspective, I've just personally found over the arc of my my experience that the large banks just tend to have the best technology, and it makes it much easier for companies to operate. So whether that's processing payments with customers, or just managing cash from a treasury management standpoint, or paying your bills. Conversely, I found that the regional banks are much more customer service oriented, particularly with respect to loan origination. And it sounds like technology can help the large banks remain competitive, in the area of loan origination. But when I'm going to ask the regional bank for money, I'm going to call somebody and have like an in-depth conversation with them on the topic. Albeit that regional bank tends to have like less compelling technology solutions. So it's kind of an interesting conundrum around how we think about accessing capital markets, because oftentimes we'll say, hey, great news, guys, we got a loan from this regional bank, and then we'll hear from our controller how unhappy they are with some of the technology solutions at times. So I think it'll be really interesting over time to see how regional banks can partner with or harness technology from fintech companies, over time to help, pair really great customer service and maybe a little bit higher quality, technology. And although I'm like nowhere near an expert on this topic, like I just think the idea of AI in the space of the financial services industry is like probably worthy of its own panel as well. And I think it'll be interesting to see how that comes to be.
A lot of interesting stuff ahead. I want to bring this conversation to a very noisy close. I want to focus on public policy and small and medium-sized businesses. Those businesses are on the, they're the beneficiaries here. They're the ones we're talking about when we talk about banks, when we talk about regulation, when we talk about turmoil and interest rates and private credit. And Kevin, what you do, those are the businesses who, you might want to work with or want to work with you, or work with Jamal's members or those banks. So, I want to ask you each about your guidance for policymakers. They're pushing forward on this regulatory scrutiny, that'll extend to banks, it'll extend to non-banks. I just want to ask each of you, what is your guidance to policymakers here as they move forward, especially, what would be your guidance for policymakers on how they should or shouldn't proceed for the benefit of those small and medium-sized companies who we've talked about? Jamal, I'll start with you. I'll just go in the order of my screen. What do you want policymakers to keep in mind as they move ahead here?
I think policymakers need to keep in mind that they need to make sure that the regulation doesn't stifle innovation in the space and doesn't stifle access to capital for the small and medium businesses. I think that's an important thing for policymakers to always think about as they set public policy.
Kevin, I'm just going to keep in the order of my screen here.
Yeah, so it's somewhat similar concept, I think, to what Jamal's raising, which, you know, what I kind of, the prompt I have here is like less can oftentimes be more. And, you know, is kind of the thought that came to mind when thinking about this question, and or if you think it's really prudent to introduce new regulations, then like let's try and keep them as simple as we possibly can. You know, it's like from the operator's perspective. Last thought on this prompt from my standpoint, it's more of like the opposing of a problem than a suggestion for a solution, is that, you know, I tend to find that there's like a flight to quality when the market, when money stops moving so easily. And that really impacts small and medium-sized businesses very negatively. And anything I think we can do to help support small and medium-sized businesses, you know, at these moments of market dislocation, I think generally is a positive thing without overdoing it, all told.
Thanks, Kevin. Steph?
Yeah, I think as I was alluding to, there's too much complex regulation out there. If you just look at bank capital regulation, it makes up 20% of all the regulatory code at the federal level for the OCC and the FDIC, just for regulatory capital, which is just a tiny fraction of a bank's balance sheet. And I'd rather see, I think it would be more effective if you went just with a simple comparison of market and book equity, and you went from there. If you're talking about the bank regulatory space, what I've found also is that larger banks, I don't think risk-based capital reduces lending overall, but what seems to happen is that the largest banks have a much smaller fraction of their portfolio in loans, and especially C&I, commercial and industrial loans, because those require the most capital. So in that sense, that's why the smaller banks can step in, as well as the non-bank financial firms can step in and fill the gap. So they do that. But I would say that that would be my concern, that the regulatory code is just too complex, and it's fostering bigness, and I think it may be stifling innovation.
Thanks, Steph. That's a stunning stat, at least to me, on the 20% of the regulations. That was surprising. I know I promised you that we were bringing the conversation to the close, but we do have another question from the audience I want to make sure we mention. It's from Ben Calzini. I hope I'm saying that correctly, online. He wants to know if any of you have a view on the role or an awareness of the role that government guaranteed loans play for small business. You know, the SBA has the 7A program. They guarantee loans. It's about somewhere between 20 and 30,000 each year, somewhere between 20 and $30 billion each year. You know, if you kind of back out of the CFPB's estimates of the total value of the small business lending market, the SBA is probably helping guarantee somewhere around 10%, less than 10% of all the new credit being given out to small businesses each year in the US. But Ben wants to know if any of you just have thoughts or an awareness of the role of those government guaranteed loans, or, you know, how you perceive them in the market. I'll just leave that for anyone to respond, to jump in.
Yeah, I mean, I'm happy to start initially. So I'm by no means an expert on some of these like loan programs, but they are. I see them used a lot in small and medium-sized business acquisitions or refinancing. So I think they tend to be great solutions for business owners to access capital more easily. Or conversely, I'm seeing a lot of young entrepreneurs who want to own a business, and they raise SBA, backed kind of debt financing to help facilitate a transition in ownership and allow, a previous business owner to retire. It's kind of how I see the debt used, or these programs used most commonly from my kind of glimpse into the world. And in any event, I think they're fantastic programs, given all that goodness that comes along there. The one thing that personally I've always had a hard time the reason why I've stayed away from undertaking loans from SBA oriented programs, the 7A, lending program. I'm using the wrong terminology here. Is that oftentimes those loans come with a personal guarantee, so it requires just more personal liability or risk than just from a personal decision making standpoint that I'd want to undertake. And if there was more flexibility on that dimension, I think it'd be even a wildly more popular program, for what it's worth, in my opinion.
Thanks, Kevin. Steph, Jamal, any comments on that question?
I'm not really familiar with the program.
That's fine.
So yeah,
Totally fine.
I don't have anything to add either. So.
Kevin, you're exactly correct. We hear that a lot from small business owners too. But on both, I think your main points. One, the important role that those loans play, and whether it's acquisition or refinancing, but then also the personal guarantee being a barrier. I think you see that in lots of survey results too, especially from the Fed's small business credit survey. Now we really will bring the event to a close, but I just want to offer you each a lightning round chance for any final comments or thoughts before we let our audience go. I'll go in reverse order. Steph, lightning round, any final thoughts?
Expect more potential bank failures.
Kevin?
Well, first off, thank you for having us. And second, I think it's going to be tough sledding here for another, 6-12 months, regrettably. So let's keep working, keep grinding.
Jamal, last word to you.
Thanks for having us, first of all. And I think one takeaway for the viewers is private credit is an additional source of capital for businesses to grow.
I want to thank our audience. Oh, no, thank you. Thanks to our panelists, and thanks everyone for tuning in to a Bipartisan Policy Center event. Thanks, everyone.
Thanks.
Yeah. Take care.